Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good afternoon. We got FOMC. It's here. A big deal. I'm trying to hype it up. I'm not doing a very good job, am I? Okay, but check this out. Like, the treasuries are higher. Like, we were earlier the day, we were like stuck around 050, right? That was like the big distribution was at 050. Doesn't look like that anymore. No, does it? Yeah, no, most of the volume up at 07. Hey, Stick. So, yeah, they're going to be interesting. Here we are. I know. It's like, this, I'm like, we're super pumped, right? Are you super pumped? I'm like really tempted to YOLO this. I'm so, you know what? We'll do it on Sim. We'll definitely do it on Sim here. Yeah, I'll just go short that. Sure, why not? You can see the level 2 pull on here. Not all, there's still 200s on the micros. That's interesting. You know, I'm sure that he will pull out after a minute or so, but think I'll get the fill. I should get the fill there. There's some volume going into it. Come on. Your long VIX. What's your read? Well, I would say I suspect that we're going to move down, but so this move up I think was largely driven by Evergrande. So we may be getting like a really good price here, right? But I don't know. There's a lot of I think there's a lot of variables in here, right? Like, even if I'm correct that they make some sort of well, I don't think it will be like a huge thing in the statement, but I don't know. Even if I'm right and they're hawkish, the market might not react the way that I want it to. So they might say it's already priced in. So we'll see. Let's see. It's like, financial juice going. I got TweetDeck. Oh, can I do the? I don't know if I have enough requests left for text to speech, so I need to download the new version of OBS. It has the YouTube stuff built into it. Okay, yeah, it should work for a little while at least. There we go. I suppose we could like stop limit into something, but look, it's like going down. You're not. No, I'm working, but it's lunchtime. It's lunchtime. Okay, here we go. 10 seconds. Okay, wow. Okay, Fed says moderation in bond buying pace may soon be warranted, reports Bloomberg. Captain Price? Oh, okay. It's flat. Okay. So they have shown in recent months the rise in COVID-19 cases has slowed. Since the economy has made progress towards these goals, if progress continues broadly as expected, the committee judges that a moderation on the price of asset purchases may soon be warranted. That is the change that they made. So the only real change in this statement was that the pace of asset purchases may soon be warranted. We are still above 133. I think we can sell at anything above 133 and then some. Because remember where we were on Friday? I got a little bit of lunch here that I want to eat before the press conference, but I think we can let this ride a little bit. Okay, so Lucas is saying, please note they will just slow the pace, which means they're not pulling the foot off the pedal. Well, what they're saying is that they're going to taper, right? They're not going to buy as many treasuries every month, and then eventually it will go to not buying any treasuries every month, right? So they put an explicit acknowledgement of the taper in the interest rate statement that suggests that they will raise interest rates or that they will taper before the end of the year. So the dollar moved up and it's all flopping around right now. The S&P 500 kind of looks bullish at the moment. We'll see. Is it priced in? How do you know? How do you know? Explain this to me. Why were we like crashing below 133 even last Friday if the taper's priced in? Is gold rallying at the moment? We may be getting like these what do you call them? You know, we may be getting those liquidity hole reversal sort of things that will like flip the other way again. So I was worried about that right there. There might have been some change in the dot plot that I'm missing here. Not sure. I am seeing the Bitcoin is moving too. A little bit up. The instruments all made the correct move at the beginning, so this might just be the head fake. I think that you guys are making a little bit of a misread here. So, remember what were we talking about earlier? Price is what? Price is bullshit. Look at the orders, guys. Every single one of the treasuries so far, all of the market orders have been sell orders. So all of these reversals and so forth that you're seeing are more likely to be reactions to the lack of liquidity going on, and not necessarily a market call on the direction that the market should go based off of the news that we just had from the Federal Reserve. Right? We have to wait for the liquidity to come back and for things to stabilize before we can really see that. Now, it could reverse and we could see some buying, so I'm not going to, but I would just say I would not take this read like the Treasury's moving down and then coming back up. I don't think that you can sit down and say that that people don't trust the Fed or they're, I don't think that any of those things are true. But here's what we did get. Number one, the Federal Reserve does plan on tapering before the end of this year. And they're confident enough on it that they've put it in the statement. Two, they raised their inflation forecasts. They raised their forecasts on PCE is some of the things that I'm hearing here. So yeah, I don't see anything dovish about this. See buy orders in Euro futures, but when it's low liquidity like this, I mean, are you really seeing really strong volume, unusually strong volume coming in? Or right now in the Treasury, we saw 1,000. Well, actually, it was probably more let's see here. 15,000 contracts short come in through here, right? Now gold moving higher, that's kind of weird. They did move lower initially, and then they reversed. So the S&P 500 also moved down lower initially and moved back up. So let's see. US dollar reverses course and moves lower after Fed statement. Trading late today. Well, we got the FOMC, of course. We got a little sim position in here in the Treasury. I don't know if it's, it was doing really good at one point, but and now let me just go through here because there might be something about the dot plot or some of the other data. Okay. FOMC signals taper may soon be warranted. Dot plot shows rate hike in 2022. Heading into today's pivotal FOMC statement, the dot plot update and press conference update, U.S. equities were doing their usual FOMC drift higher, but since last FOMC, bonds are best. Stocks are worse with dollar modestly higher, and blah, 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 blah. Median inflation expectations have jumped, and the 18 Fed officials are evenly split on a rate hike next year, which hiked the median plot to a half rate hike by the end of 2022. Interestingly, the median forecast of a 1% federal funds rate at the end of 2023 was only 1.8% at the end of 2024, which Bloomberg Chris Ansley notes suggests either some Fed policymakers are anticipating a pause in the rate hike cycle, or they may have in fact lowered their estimate for the so-called terminal rate, the endpoint of the rate hike cycle. Okay, so here they're showing you this was the June dots, and this was the September dots. And you can see that a lot of dots have moved over into 2022. So every piece of this setup was hawkish. Treasuries are flipping up a little bit here, though. Forex Live, it asks the obvious question. What are they saying? This is playing out according to script. The Fed is playing second fiddle to China today. Whether there's a taper in November or December doesn't matter. We get a nod that a taper is coming this year in the statement, and that's about all the hawks could have expected. The surprise came in the dot plot, which shows an even split of 9 Fed members forecasting a 2022 hike and 9 forecasting no change. I'd wager that the 9 saying no hike included the core Fed members that matter, especially Powell, so tie goes to the home team. Still, there's a new SEP in December, and we're now 1 dot away from the majority seeing a hike. The 2023 dots are hawkish as well. So why is the dollar falling? Why are stocks rallying? It's not about the Fed. As I wrote earlier today, it's all about Evergrande. A deal is probably done. So while markets have offered some positive ticks, there's still a considerable way to go here. Obviously, there's going to be some waiting until after the Fed, but assuming no big hawkish surprise, we'll see a flood of buying and risk assets afterwards, and that's what's unfolding right now. So they think that the markets are bullish at the moment because Evergrande risk coming off. Well, I am not showing any stocks data here. I'm looking at only futures right now, and I use CQG Kinetic right now. Used to use Rhythmic. I liked Rhythmic. I wouldn't mind going back to Rhythmic, but apparently I'm not allowed to right now. Okay, we did see the 30-year get kicked off of its highs, by the way. That's probably one area that we need to keep an eye on because everything flattened when we would expect it to steepen. Like, I should expect the 30-year rates to come up more than the 5-year rates, but that's not what happened. Well, it's interesting because remember I was like, well, I think that maybe the Treasury could see even more downside because I would like to see the 10-year below 133 even. That's not happening. Not yet, but could still happen. Inflation still transitory. I don't know. Absorption barriers. So I don't understand a whole lot about when he's talking about absorption barriers. That's not something I've studied. I'm seeing a lot of people everywhere saying, well, they must not have liked it. It was not as hawkish as they wanted. Where was that? Oh yeah, it was a zero hedge edit. I don't know. I'd have to look more at because he's talking more about asset pricing stuff that I'm not as familiar with. But he talks about it in Bitcoin, his Bitcoin paper, right? Okay, so the E-mini turning down now. Quite quickly, too, by the way. Treasury's moving down a bit. Yeah, that right there in the E-mini, that seems like a little quick. pull up the live. Okay. Weak support. They're disappointed. I'm a bullish hawk. Well, now I'm seeing buy volume come into the 30-year. That is the way that this is tilting. It's steepening now. It is steepening. I'm very curious though. Like gold did make the move that you would expect at the beginning, and then it moved higher. Yeah, I don't know. This isn't necessarily the kind of move that I would expect to see off of this kind of news, but it might not mean anything. It does appear to be somebody selling it at 10.5. What about this 6J? Let's reset that. I am kind of seeing like if the ZB decides to start taking us below 164 even. See, ZB did not tick up that time. Use a funding company, HF. You've been trading the 30s now? Huh. Oh yeah, here they're starting the news conference. I have it up here. So I'm going to go away here so you can see him. Huh. Let's reset this. Oh, you can't hear him. Is it this one?
750,000 per month over the past 3 months. In August, however, job gains slowed markedly, with the slowdown concentrated in sectors most sensitive to the pandemic, including leisure and hospitality. The unemployment rate was 5.2% in August, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs and ongoing fears of the virus, appear to be weighing on employment growth. These factors should diminish with progress on containing the virus, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.8% at the end of this year and 3.5% in 2023 and 24. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year. While these supply effects are prominent for now, they will abate, and as they do, inflation is expected to drop back toward our longer run goal. The median inflation projection from FOMC participants falls from 4.2% this year to 2.2% next year. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could again prove to be greater and longer lasting than anticipated, posing upside risks to inflation. Our framework for monetary policy emphasizes the importance of having well-anchored inflation
Still see it, Stephen. You see the 5 and 10 are kind of sticking up there, but the 30 is a down a tick.
To promote our broad-based and inclusive
Now the 30-year might drag them down with it, but let's just see.
Longer-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If sustained higher inflation were to become a serious concern, we would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. The path of the economy continues to depend on the course of the virus, and risks to the economic outlook remain. The Delta variant has led to significant increases in COVID-19 cases, resulting in significant hardship and loss, and slowing the economic recovery. Continued progress on vaccinations would help contain the virus and support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted
Our market's pricing in the next QE already. That's what Zero Hedge is asking.
Since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. We also discussed the appropriate pace of tapering asset purchases once economic conditions satisfy the criterion laid out in the committee's
My wife got me
guidance.
lunch, and I had already eaten
Although
something.
decisions were made, participants
Oh, look at
generally
that. I
view
came
that,
back.
so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate. Even after our balance sheet stops expanding, our elevated holdings of longer-term securities will continue to support accommodative financial conditions.
What is the ticker for the 30-year yield? It depends on your platform, but for me on NinjaTrader, it's 30YR.
To carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test.
So when he was
Continue to
talking about
expect
that there,
it would be
the
appropriate to
treasuries
maintain
got
the current
pulled
0 to
down pretty hard,
1%
but the
target range
ZB
for the federal funds rate
recovered quickly.
until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. Half of FOMC participants forecast that these favorable economic conditions will be fulfilled by the end of next year. As a result, the median projection for the appropriate level of the federal funds rate lies slightly above the effective lower bound in 2022. Participants generally expect a gradual pace of policy firming that would leave the level of the federal funds rate below estimates of its longer run level through 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. More important than any forecast is the fact that policy will remain accommodative until we have achieved our maximum employment and price stability goals. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, We at the Fed will do everything we can to support the economy for as long as it takes
So
to
something
complete the
that
recovery.
you hear him saying
Thank you. I
everything,
look forward to your questions.
taking extra note to say, hey, we're doing this because we're doing our job and everything. And
Rachel Siegel.
I think that there might be a lot of
Thank you,
discussion
Michelle,
here in
and
the
thank
press
you, Chair
conference
Powell, for
about
taking our questions.
the
When it
trades
comes to
that
the
they'd been
taper
making.
and eventually
Yeah.
to any rate increases, I'm wondering if you can walk us through what substantial further progress looks like given the latest batch of projections that have PCE inflation coming in a little higher than the June projection, the unemployment rate also being higher than June, as well as the change to GDP lower than June. If you could help us make sense of all those things as you sort through what substantial further progress looks like, that would be great.
Sure. So the test for beginning our taper is that we've achieved substantial further progress toward our goals.
Okay,
of
now
inflation
that's
and maximum
falling
employment.
fast.
And for inflation, we appear to have achieved more than significant progress, substantial further progress. So that part of the test is achieved in my view and in the view of
5K
many
out of
others.
7, huh?
So the question is really on the maximum employment test. So if you look at a good number of indicators, you will see that since last December when we articulated the test and the readings today, in many cases, more than half.
By the way, the
distance, for
dollar,
example,
the
between
gold has
the
reversed now.
unemployment rate in
Wow,
December
gold
of
reversed
2020
fast.
and typical estimates of the natural rate, 50 or 60% of that road has been traveled. So that could be substantial further progress. Many on the committee feel that the substantial
He
further
looks a
progress
little
test,
unhappy.
for employment has been met. Others feel that it's close. They want to see a little more progress. There's a range of perspectives. I guess my own view would be that the substantial further progress test for employment is all but met. And so once we've met those two tests, once the committee decides that they've met, and that could come as soon as the next meeting, that's the purpose of that language is to put notice out that could come as soon as the next meeting. The committee will consider that test, and we'll also look at the broader environment at that
You
time
went short
and make a
crude.
decision whether to taper.
Crude's about the only thing that's not moving like big time right now.
Thank you. We'll go to Howard Schneider.
Thanks, Chair Powell.
Oh,
Thank
look
you,
at that.
So looking
Look
at
at
the
that.
steps, we got now basically
Now below
4 years
04
of
half.
inflation above target, and policy never gets to the long run rate. I'm wondering if you could address that from two perspectives. One, within the new framework that the Fed adopted last year. And second, from the perspective of the average household that's now being asked to pay higher prices and increasingly higher prices for 4 years running, when for some this year, real wages have actually gone down.
Sure. So as you can see, the inflation forecasts have moved up a bit in the out years. And that's really, I think, a reflection of...
Based on the
significantly for this
synthetic
year.
dollar. Look,
And
the
that's,
dollar's
I
coming
think,
up
a
strong
reflection,
now.
Of the fact that the bottlenecks and shortages that we're seeing in the economy have really not begun to abate in a meaningful way yet. So those
Oh,
seem
that
to be
that was
going to be
financial
with
juice
us
making a
at
sound.
least for a few more months and perhaps into next year. So
I
that
think it was.
suggests that
I
inflation's
don't
gonna
think
be
it
higher
meant
this
anything.
year,
I think it was a
and
delay.
There were, I guess, the inflation
Hey, Ao,
rates
how are you
for,
doing? I know I'm a little stressed right now. I feel because the market's not necessarily doing what I expect, but
why
we're okay. I think we're okay.
Looking at 2.2 and 2.1, 2 years and 3 years out. These are very, very. I don't think that that households are going to notice a couple of tenths.
Now
of
that last move down,
forecasts.
they flattened a bit.
We want to.
But it flattened because the 5-year came back hard.
2% over time.
Look at how hard the 5-year came.
Those things. In terms of the framework, I see this as very consistent with the framework. We want inflation expectations to be anchored at around 2%. That's really the ultimate test of whether we're getting this done under the framework. And we do want inflation to run moderately above 2%. I wouldn't put too much on a couple of tenths over 2% in 2023 and 24, 1/10 in 24. But you're right; those are the numbers.
Thank you. Let's go to Colby Smith.
Chair Powell, thank you, Michelle. Chair Powell, you mentioned
I was
ongoing
dozing off and that
discussions about
siren
the
woke me up.
timeline, and I'm wondering what the contours of that debate have been.
I
For
am
those
good.
that
The
want to
ES is dropped.
move,
Oh yes,
a bit
because
more
you're still
quickly,
short.
Is it about
So it was
maintaining
getting
functionality for a 2022 interest
getting
rate
pretty
increase,
bullish there for a while,
or
huh?
is it about financial stability risks or concerns about the efficacy of asset purchases at a time when we have supply constraints? Thank you.
So let me say that there's very broad support on the committee for this plan, both as to the timing and as to the
U.S. dollar
pace of the
reverses
taper.
declines
So this was
after
a unanimous
Powell
vote today,
outlines
and I'd say
timeline for taper.
Quite broad support for this approach. You're correct that there are some who would prefer to have gone sooner, and they've made their arguments publicly. For some of them, it's a financial stability concern. And for others, it's other concerns. They can make their own arguments. This is an approach that the committee will broadly support, and it will put us having completed our taper sometime.
So I didn't highlight it when you said it here, but Powell said the language in the statement is meant to flag bar for taper could be met as soon as next meeting.
In the early stages of the crisis, they were essential in restoring market function in the Treasury and other markets. Then as the recovery got going, they supported aggregate demand, as they will do. And now we're in a situation where they still have a use, but
I'm late to what exactly?
To taper them. Their usefulness is much less as a tool than it was at the very beginning. And of course, this leaves the whole question of rate increases ahead, which is really where the framework is all about how we deal with rate increases and that sort of thing. So we think this is the appropriate way to go, and again, broad support on the committee.
Thank you. We'll go to Nick Timrose.
Look at that go.
Chair Powell, you have said the test for liftoff is more stringent than the test for tapering. But if the near-term projections today are credible, more of your colleagues seem to think that rate liftoff and not just a taper may be closer at hand. Does the committee have a different opinion than you do about the threshold for liftoff?
Does the committee have a different opinion than you do? Oh, you should not ask that, my boy.
Sooner than you do.
But it is a question that people have wondered.
Substantial further progress toward our goals.
Because some people are saying that the people that actually vote are more dovish, essentially.
The taper takes some months, and everyone's figuring. So you're going to be well away from satisfying the liftoff test when
okay, hey, thanks for stopping by.
In terms of the liftoff test, though,
glad to see you're happy.
It's what we adopted last September. It's labor market conditions consistent with maximum employment. And while we
has broad support on the committee.
Interesting signs that in many ways the labor market's very tight. We also have lots of slack in the labor market, and we think that those imbalances will sort themselves out.
Yep, I'll see you tomorrow.
Inflation at 2% and on track to achieve moderately higher inflation over 2%. That really depends on the path of inflation. If inflation remains
so this most recent move back up again, a liquidity hole that we got, like everything from 04 half and below was quite illiquid when they moved.
If you look at what people are writing down for year-end 2022 numbers, some people are writing down very low unemployment rates, and that's only one indicator, but it suggests a very strong labor market. And I think they're writing down in good faith what they see as meeting the test. There's a range of perspectives about where the economy will be, but by the way, all but one participants have us lifting off during 2023. So it's not really an unusually wide array of views about this.
Thank you.
So do you adopt some form? Are you talking about the Kelly criterion?
We'll go to Gina Smialik.
Taleb has a really good video about the Kelly criterion on his YouTube.
Prior to recent media reports, were you aware of the kind of security buying and selling that Presidents Kaplan and Rosengren were participating in last year?
I'm going to say I don't. I'm probably over-leveraged. I don't know.
So, no, I was not aware of the specifics of what they were doing. So let me just say a couple things about this subject. We understand.
If I was managing a much larger amount of money, I would probably put more emphasis on that. But with the way that I trade, I basically just do the minimum that I can work with.
A comprehensive review of the ethics rules around permissible financial holdings and activity by Fed officials. So those rules are in many respects the same as those for government agencies, plus a number of things that apply specifically to us because of our business. One of those is sort of three things I would point to in terms of specific restrictions. One is ownership of certain assets is not allowed, and that's bank securities and other things. Secondly, there are times when we're not allowed to trade at all, or to buy and sell financial assets, and that's the period immediately before and during an FOMC meeting. And third, there's regular disclosure. So all of these, everyone's ownership and activities are all disclosed on an annual basis. So I would have had to go back and read people's financial disclosures to know what their activities have been. This has been our framework for a long time, and I guess you'd say it's served us well. The other thing you would say, that it is now clearly seen as not adequate to the task of really.
That's not the way that you want to present it, Powell.
Yes, we need to make changes, and we're going to do that as a consequence of this. This will be a thorough.
Okay. Well, they are going to make changes. That's good.
Comprehensive review. We're going to gather all the facts and look at ways to further tighten our rules and standards.
Great, thank you. We'll go to Steve Leisman.
Thank you. Thank you, Mr. Chairman. I want to follow up on Gene's question. The issue of ownership of these stocks and trades, do you think
2:30 p.m. was a nice trap move? Yes, it was.
Owning the same assets that the Federal Reserve is buying, is that one of the modifications that you're looking at? And in that,
listen to these guys.
They don't clearly not seen as appropriate.
See, the media is going to be way more interested in that subject than the actual statement in economics.
Do those trades, in fact, and holdings violate the Fed's code of conduct? Finally, do you have a timeline as to when you might be done with your review? Thank you, sir.
Don't have a timeline yet. We can start with that. Well, let me address the Muni question, since that's
well. The thing that's interesting about the Keller criterion is that as you get bigger, you actually can't risk more of your portfolio. Like when you get bigger, when you get into the fat tail, it affects you more, and so you have to risk less and less. So for you that's starting at the beginning, where you're risking as little as possible and still play, it's not necessarily pertinent, but it is a very important metric to keep in mind as when you start sizing up.
And so then comes
you won't be able to size up at the same level that you were. The bigger that you get, the less you can size up. Not only because the market can't handle it, but because
very much on the verge of collapse. And it was time
the risk of ruin
go,
increases.
And we did. But we also checked with the Office of Government Ethics, who looked carefully at it and said that I didn't have a conflict. So that's one answer that I wanted to share with you. Secondly, you're right, though.
Forex Live says that Powell throw Kaplan and Rosengren overboard.
The process here and speculate about particular outcomes. But this, again, comprehensive and deliberate process. We're going to make changes. I want to be able to look back on this years from now and know that we rose to meet this challenge and handled the situation well, and that what we did made a lot of sense and protected the public's interest and the
very
institution that we're all
still.
part of.
I got 4366 marked.
I just want to follow up. You said I was right when you said right about that the Fed should not own.
Darius stuff is golden. You haven't lost a single trade today, really?
I think that's a reasonable thing. Yeah, and of course, for the most part, we don't. I mean, it was a real coincidence. I happened to pre-own these munis. They were bought many years ago, actually, and so we started buying munis as part of the municipal liquidity facility. So it was really not a. It just
out of how many trades, though?
And I couldn't sell them, so what I did was I just held them, checked with the ethics people, and went ahead. So, but as a general principle, yeah, that makes a lot of sense.
Thank you.
Thank you. We'll go to Chris Rugaber.
Thank you. Thank you, Chair Powell. Well, I had a question
20 on MES and you haven't lost a single one? That's impressive.
The Fed's
what was your risk or reward that you were going for?
Framework of you laid
like how many
here.
ticks?
You and other Fed officials have often talked about expecting a job market pickup in September as more children return to school.
Oh, that's not Ford today. Ford, that sounds more reasonable.
You have mentioned in the past.
Can totally get Ford, especially a day like today, because there's been some strong momentum, huh?
Suggesting that we may not be seeing much of a return of labor supply. So do you still expect to see that in the next
Oh no,
couple of
four
job
ticks.
reports? And how would a relatively
Four
weak
tick
jobs report
profit,
in September
4 tick stop.
affect your plans? Thank you.
So you're right. We have a really, I'll call it a unique situation where by many measures the labor market is tight. And
Yeah, okay. That's a pretty standard for students. And
very
yeah.
widespread reports from employers all over the economy saying it's quite difficult to hire
You're
people,
not 100% off
which
of
is moving
20
up in
trades,
that.
are you?
It's quite a tight
I suppose on a day like
labor
today,
market. Our view,
that might be
I think
reasonable.
widespread view a few months ago was that several things were coming together in the fall, including
where you really be tested is on a day where it's way more
duties,
mixed.
including the expiration of extra unemployment benefits, and other things would come together to provide an increase in labor supply, and so we'd get out of this strange world where there are
That's what I'm saying.
a high unemployment rate, but a labor shortage.
I think I got a good idea what you're saying.
Delta happened, and you have this very sharp spike.
And were you just trading
Delta
the ES
cases,
against the NQ and the Dow?
For example, when schools are open 60% of the time, or when they're always at a threat of being closed because of Delta, the Delta variant, you might want to wait rather than going ahead and taking a job and starting work only to have to quit it 3 weeks later. You're going to wait until you're confident of that. So some of that may not have happened. Also, people didn't, as you know, hiring and spending in
you're
in these
using them as
face-to-face
correlation.
service
Okay.
industries, travel and leisure, it just kind of stopped during those months. So that really the big shortfall in labor in jobs was largely in travel and leisure, and that's clearly because of Delta. So that all happened. And so what we know is that it didn't happen. I think there's still it may just be that it's going to take more time, but it still seems that inexorably these are people who were largely working back in February of 2020. They'll get back to work when it's time to do that. It just may take longer time. You're right, though. It didn't happen with any force in September.
They'll still hold it, but sometimes these
Delta.
treasuries, when they move, it just goes on nothing.
In terms
Like
of
they could get
the
below
US
133.
also
We
the
could
test
see some
for
real
November.
puking still.
I think if the economy continues to progress broadly in line with expectations, then I think also the overall situation is appropriate for this, then I think we could easily move ahead at the next meeting, or not, depending on whether we feel like that those tests are met.
Well, if I just quickly follow up, I mean, how much of that will depend on what kind of jobs report we get for September? And I mean, is it, are you in a data-dependent phase here where you need to see certain numbers going ahead, or are we at a point where you've accumulated enough progress that?
So it's accumulated progress. So for me, it wouldn't.
I'm also cheating a little because that's totally legit way of doing it, though.
It would take a reasonably good.
So are you reversing those areas
then?
then?
That test is met. And others on the committee, many on the committee feel that the test is already met. Others want to see more progress, and we'll work it out as we go. But I would say that in my own thinking, the test is
now they're below 133.
So I don't personally need
yeah.
to see a very strong employment report, but I'd like to see a decent employment report. I mean, it's not to be confused with the test for liftoff, which is so much higher.
Great, thank you.
Okay, thank you. We'll go to Victoria Guida.
Hi, Chair Powell.
Yeah,
I
close to
wanted
them.
to ask about the Vice Chair of Supervision position, and I was wondering if you could speak about how you view that role and the extent to which you
what I
defer
have
that
found
person on regulatory policy.
I'll
and then just
mute
sort of
him
a
for a little
related
bit,
question.
or turn him down
as
for a
you know,
second.
Randy Quarles is Vice Chairman.
What I find with it is that when you have the markets that want to move, that with the trending action that you'll get, that almost makes it easy. It's like, the S&P 500 at the moment is on the downturn. You get a little move against it that is not in line with the others. You take it, and it's easy money almost. But on a more regular day, it kind of becomes a little bit more difficult. And that's where you're really going to be tested, is like identifying when it's actually appropriate to take it.
Vice Chair Quarles did it.
That's the hard thing.
And I would,
because you'll see the opportunities a lot, but you don't necessarily want to take all of them.
the person who will set the regulatory agenda going forward, and I would accept that. And furthermore, you know, it's fully appropriate to look at.
So for me, when I've done it in treasuries, it's
the current state of regulation
super hard because there aren't very many opportunities.
Suggest appropriate changes.
Now they bounced back hard off of that last move down.
In terms of Vice Chair Quarles' term, we're not currently in that situation, and I actually don't have any updates for you on that today. We'll keep you posted on that.
Thank you. We'll go to Steve Matthews at Bloomberg.
Thank you. Chair Powell, I wanted to ask about the inclusive monetary policy framework. In particular, Bloomberg surveyed economists, and we found that they predict liftoff will happen when the U.S. unemployment rate is 3.8%, but the Black unemployment rate is 6.1%.
Oh, by the way, Powell was saying it wouldn't take a knockout employment report for me to feel taper test has been achieved.
Americans is consistent with full employment.
Is the way that they're interpreting that last bit that he was saying?
Inclusive growth strategy.
Right. So the point of the broad and inclusive goal was not to target a particular unemployment rate for any particular group. Really, we look at a broad range of
oh man, it's trading there in the 10-year. It is trading. Look at that.
When we think about what maximum employment is, and one of the things we look at is unemployment rates and participation rates and wages for different demographic and age groups and that kind of thing. So we will do all of that. So I think if you look back, what were we really thinking? So we all saw the benefits of a strong labor market. If you look at the last 2 or 3 years of before the pandemic hit, you saw, after a lot of long progress, you saw a really strong labor market, and you saw wages at the low end moving up faster than everywhere else, something that's great to see. We also saw the lowest unemployment rates for minorities of various, for African Americans, for example, and also participation rates. I mean, we saw a really, really healthy set of dynamics. And by the way, there was no reason why it couldn't continue. There were no imbalances in the economy, and then along came the pandemic. There was nothing in the economy that looked like a buildup of imbalances that could cause a recession. So I was very much thinking.
I see you up there, that little 5 lot at one spot, 3, 4, 5.
Great. So we're all quite eager to get back to that.
You're finding yourself scratching and canceling orders often. That's good.
Raise rates just in response to very low unemployment in the absence of inflation. So that was another aspect of it, because we saw that really benefited labor market participants in a broad and inclusive way. That's, of course, not the current situation. We have significant slack in the economy and inflation well above target, not moderately above target. So that's really how we think about it. It isn't really just targeting the headline numbers, but it's about taking all of those things into account in your thinking about what constitutes maximum employment.
I guess just to follow up, should there be a significant gap between Black unemployment and overall unemployment for structural reasons that are outside of the control of the Fed that other people should be doing something about? Or should the gap be narrowed, if not down to zero?
Well, first of all, ideally there wouldn't be any gap, of course. We would all love to see no such gap. This is a persistent gap, and it's very hard to explain based on typical metrics. It's quite troubling, but it really is.
I'm out of water. I need more water.
We have, famously broad and blunt tools. I think eliminating inequality and racial discrimination and racial disparities and that kind of thing is really something that fiscal policy and other policies, frankly, education policies and that kind of thing, are better at focusing on. I think we've identified the part that we can do, and we'll do that part. But I've always been clear that it's going to take policies broadly across society to work on these problems.
Thanks.
Thank you. Let's go to Michael McKee.
A plan for dealing with a debt default. that included prioritization, that included changes in bank regulations, and possibly selling.
Wow, look, Michael McKee, he's got like the super professional setup now.
Are any of all of those still on the table? Do you think any of those would work? And,
beautiful setup.
What would happen to the economy?
That's the first setup I've seen in the FOMC that makes me jealous.
The first few words, but I think I got your question.
Here's mine.
So it's just very important that
I think he's got a nice. That's a nice camera.
So that the United States can.
I'm impressed, Michael. I'm impressed.
That's a critically important thing. The failure to do that is something that could result in.
I'm really thirsty. Let me get some water. All right, be right back.
Severe damage to the economy and to the financial markets, and it's just not something that we could contemplate. That we should contemplate. I'm not going to comment on particular tactics or things like that. I'm just going to say that I think we can all agree that the United States shouldn't default on any of its obligations, should pay them when and as due, and that no one should assume that the Fed or anyone else can protect the markets or the economy in the event of a failure, fully protect in the event of a failure to make sure that we do pay those. That's when they're due.
If I could follow up, have you discussed options with members of Congress?
I don't generally ever talk about the conversations I have with elected officials or other appointed officials. But look, you can see that this is a major focus among those who have responsibility for it, and including elected people.
Thank you. Let's go to Hannah Lang.
Hi, thanks so much.
Right.
Senator Warren sent you a letter last week urging the Fed to break up Wells Fargo, citing what she called ungovernable behavior from the bank. I was just curious, under what circumstances would the Fed actually consider revoking a financial holding company's license, and if the indiscretions at Wells Fargo, in your opinion, warrant such an action?
Right. So we're, of course, very closely monitoring Wells Fargo's efforts to fix its widespread and pervasive problems. They represent a serious matter to us, and the firm is required to remediate them.
Like he has a statement written up about this already.
If the firm fails to meet our expectation, we continue to hold the firm accountable for its deficiencies with an unprecedented asset cap that will stay in place until the firm has comprehensively fixed its problems. And we're not going to remove that asset cap until that's done. So bottom line is we'll take strong supervisory action if a firm is engaging in unsafe and unsound practices or violating laws, but I can't speak to our confidential supervisory assessments of any individual bank.
Thank you. Now we'll go to Michael Derby.
Thank you for taking my question. You noted earlier in the press conference that you weren't aware of the trading activity of the Boston and Dallas Fed bank presidents. As you know, all 12 regional Fed bank presidents just went through the renomination.
Do a short crude or long VIX? I don't know.
Governor Brainerd described it as a rigorous process at the time. So I want to know, did anybody at the board
Hey, you're doing okay on the short crude
activity? And
this is a bad trade.
You still have confidence in the Dallas and Boston Fed bank presidents to do their job?
Let's talk about the Fed making and profiting from a rigged market.
I don't need to tell you, we
he had good answers on that.
Reports annually.
I don't know.
I think they were just quite recently filed
Look at
for
that, back up to 04.
So I don't have any reason to think people at the board would have known about particular trading that's going on. They will see that. There are people at the Fed who see that, see the trading reports when they're annually filed. In terms of having confidence in that sort of thing, I think no one is happy. No one on the FOMC is happy to be in this situation, to be having these questions raised. It's something we take very, very seriously. This is an important moment for the Fed, and I'm determined that we will rise to the moment and handle it in ways that will stand up over time. I'm very reluctant to get ahead of the process and speculate, though, about different things. And when we have things to announce, we'll go ahead and do that. But that's really what I have for today.
So one small follow-up. I mean, I know that you didn't have the 2020 forms in hand, but you would have had past year forms in hand, and at least in the case of like the Dallas.
Yeah, like these inside bids and offers are just completely pulling quite a bit still.
That in theory could have been something that came up in the renomination process.
So that's a good question. So, the 5-year review that we do under this unusual provision of law where all of the Reserve Bank presidents are reviewed for reappointment.
Dude, Squawk tweets, Powell says he didn't front-run Kaplan.
That is really a broad review about their leadership of the institution, their performance on the FOMC, all of those things. And if there were a concern, a public concern or a private concern about something that someone had done, we wouldn't wait for the 5-year, we wouldn't wait that day if there were concerns. You're right, though. These as I mentioned, we have had a framework for a long time, and it's similar to what other government agencies have, only it's a little stricter. And it is that you can trade financial instruments, but not specific ones like bank debt. You can't trade during the FOMC period and during the meeting, the blackout period, and then during the meeting. And then you disclose all this, and we have disclosed it for years. So all of these things have been going, to the extent they've been going on, they've been a matter of public record. And, but nonetheless, so that, it was
so it goes too much on the chart.
Okay. And now you look at
I don't want to talk too much because I don't want to talk over him, but
we need to do better.
It's been some wild trading here. I'm sure that a lot of retail traders got screwed.
I wouldn't blame the people who conduct that review. I really think if someone had raised concerns or if we'd had concerns, then it would have been, but it wouldn't have been part of that process. It would have been raised instantly rather than once every 5 years.
Thank you.
Thank you. Let's go to Jean Young.
Thank you, Michelle. Chair Powell, I wanted to ask about how the Fed would balance the two parts of its dual mandate. If inflation stays elevated, but we still have a labor shortage and participation remains lower than ideal, would you hold off on raising rates, or how would you?
Powell says he thought it was a paper trade account and tweets news Squawk.
Let me say one thing. You're looking for conditions consistent with maximum employment to lift off, and those conditions can change over time. So you're not necessarily bound by a particular level of the unemployment rate or the participation rate or anything else like that, which can change over time. But more to your point, really, we actually have a paragraph in our framework, and something like this has been there for a long time. I think it's paragraph 6. And you're talking about a situation in which the two goals are not complementary. They're somehow in tension. And if we judge that is the case, what it says is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with mandate. So we used to call that the balanced approach paragraph because it had those words. So it's a very difficult situation for any central bank to be, to be in a situation where the two goals are in tension.
And I'll just choke on his own spit there.
We would sort of weigh the equities between the two,
like I do every day,
and how big are the gaps and that kind of thing. We don't really think we're in that. We're sort of in that situation, I'd say, in a short-term way, but we think we do expect that that this is.
Well, you mean he's moving back up there
because of the COVID shock and the reopening and all that. You're seeing this temporarily.
Great. Thank you. We'll go to Edward Lawrence.
Thank you, Michelle. Thank you, Mr. Chairman, for taking the question. So on corporate debt, what happened with Evergrande that we've been watching, is that a preview of what could happen with the amount of corporate debt that's out there? In the past, you've said you're watching the level of corporate debt. So what's your level of concern right now? And would you consider
I'm surprised how much the S&P 500 is bouncing here.
About the United States? No. Corporate defaults are very low in the United States right now. Corporate leverage built up over the course of the long expansion that ended with the pandemic. We were very concerned in the last year or so. We were concerned in the last year or so, and then I'd say very concerned at the beginning of the pandemic that
here he is, Edward, 2 Twitter accounts, Lawrence.
Your revenue stops for an uncertain period as things happened at the beginning of the crisis. We were very concerned that there would be a wave of defaults. Didn't happen. potentially, I mean, to a significant extent because of the CARES Act and the response that we undertook and all that. It was a much stronger response than we've ever had. And I think for whatever reason now you have very, very low default rates now among corporate debt. The Evergrande situation, it seems very particular to China, which has very high debt for an emerging market economy, really the highest that any emerging market economy has had, and the government has been working to get that under control. This is part of that effort.
The treasuries are moving down a little bit. The rates have not been keeping up quite as much.
Evergrande
right? We're down 3 and we're only up 3
and it's
here.
something they're managing. In terms of the implications for us, there's not a lot of direct United States exposure.
What is that you linking us to,
Stick? Not tremendously exposed, but
that's how to download the videos. Yeah, okay.
Global financial conditions through confidence channels and that kind of thing. But I wouldn't draw.
I don't know. That link looks a little suspicious to me. 9x buddy, huh?
Thank you. We'll go to Brian Chung.
Hi, Chairman Powell. Just wondering if you could give us an update on
Deep learning for asset pricing. It does look like a
and then whether
deep
or not
video.
you'd like to be reappointed as this chatter kind of builds up. Thanks.
I think the phrase goes, "I have nothing for you on that today."
Oh.
Sorry. I'm focused on doing my job.
He's not going to comment on the battle over him being having his term
Sorry about that. Let's go to
renewed.
Thanks for taking my question, Chair. I was wondering if in your discussion about the tapering,
I like that he's willing to play with the media on these now. That's great.
If there was any discussion about what happens to the balance sheet.
This is going to give him a lot of confidence because sometimes he's been shaky, but now you notice he's getting into it. He feels comfortable.
What's your stance on shrinking the balance sheet? Thanks.
So my thinking on this has been, let's get through the taper decision, and then let's turn to those issues. There are a number of related issues. You mentioned one, Greg, but and which you need to start to think about, and we'll do that. But we want to get through this taper decision and then turn to those issues, rather than start thinking about them now and having the minutes discuss them and get people thinking that we are focused on those issues, because we're really not. And we do have the experience of what we did last time. We've watched other countries and what they've done. So I think we'll be able to get to sensible decisions fairly expeditiously when it's time, but it's just not time yet in my thinking.
Thank you.
Thank you. Let's go to Scott Horsley.
Thank you, Mr. Chairman. You talked a little bit about inflation expectations, and there does seem to be something of a divide between market expectations and the views of professional economists, which are pretty much in line with the FOMC members, and lay people's expectations, at least as reflected in the recent New York Fed survey. How much weight do you put on lay people's expectations, and what do you think accounts for that divide?
So let's just take the household surveys generally. The New York Fed survey, let me talk about that specifically, and this is from the New York Fed. It's only an 8-year-old survey, and it does seem as though they're looking 3 years out, and it seems like there's a high correlation between 3 year and 1 year. For the most part, surveys are showing that households expect higher inflation in the near term, but not in the longer term. And that's also what expectations are showing. So there are many, many different inflation measures, of course, and that's why we have this thing called the CIE, which is it's an index of it's market-based measures, it's professional forecasters, and it's household surveys. And you just put them all, it's not, it doesn't have a lot of grand theory about it. You put them all in, and you measure the change. So you should be, and also you measure things like the dispersion and that sort of thing. So you can look at all of that, and it tells a story of inflation expectations moving up. Many of the different measures will also show inflation expectations moving back up to where they were in, say, 2013. which was before the really the drop in inflation expectations broadly happened in 14 and 15 around then. So that's not a troubling thing. But, inflation expectations are terribly important. We spend a lot of time watching them. And if we did see them moving up in a troubling way and running persistently above levels that are really consistent with our mandate, then, we would certainly react to that. But we don't really see that now. We see more of a moderate increase that is in the first part of which is welcome. And because, inflation expectations had drifted down, and it was good to see them get back up a bit. But again, we watch carefully.
Thank you. Let's go to Heather.
Okay. So you probably got about 10 minutes more left on this.
Hi, sorry. You caught me off guard. Thank you, Chair Powell, for taking my question. I really appreciate it. Again, on the taper timing, you said
I
it's gonna
think that
last
our
until the middle of
text-to-speech
next year, but
thing
with
just
your concerns about the potential
pooped
for
out here, didn't it?
risk
Yep.
to inflation, would you think you might need to have liftoff happen before you finish the tapering?
That's not my expectation. Of course, we can always. We haven't decided to taper yet, and we haven't decided the pace yet. So it's not my expectation that we would have to. We can certainly speed up or slow down the taper if it becomes appropriate, though. Absolutely. In fact, back in 2013 when we tapered, we always said we weren't on a preset course. I think this will be a shorter period. The economy is much farther along than it was when we tapered in 2013. So it makes sense to allow the runoff to happen. It's a very gradual taper. It will be when we agree on it. And but we certainly have the freedom to either speed it up or slow it down if that becomes appropriate.
But you wouldn't expect rate liftoff to happen until you're finished with that process?
It wouldn't. No, because when you're as long as you're buying assets, you're adding accommodation, and it wouldn't make any sense to, then lift off. I mean, what you would do is you'd speed up the taper. I think if that were the situation you're in. We don't expect to be in that situation, but I do think it would be wiser at that point to go ahead and speed up the taper, just because the two are then working in the same direction.
Great, thank you.
Thank you.
Okay, for the last question, we'll go to Jeff Cox.
Thank you, Mr. Chairman, for taking the question. I just wanted to check in with you to see if you have an update at all on the efforts from the Fed to develop a central bank digital currency. I believe that the report was supposed to come this summer, and indications that it's going to come this month. But the drumbeat seems to be kind of getting louder to see where the Fed's heading on this, and just wondering if you can provide some update there.
There's quite a bit of cell volume there on that one.
We think it's really important that the central bank maintain a stable currency and payment system for the public's benefit. That's one of our jobs. We also live in a time of transformational innovation around digital payments, and we need to make sure that the Fed is able to continue to deliver to the public a stable and trustworthy
Another
currency and payment
pre-planned
system.
question.
So there's extensive private innovation, a lot of which is taking place outside the regulatory perimeter, and innovation is fantastic. Our economy runs on innovation. But where the public's money is concerned, we need to make sure that appropriate regulatory protections are in place, and today they really are not in some cases. So with that in mind, and with the creation of myriad private currencies and currency-like products, we're working proactively to evaluate whether to issue a CBDC, and if so, in what form. We have two broad work streams, one of which is really technology, both at the board and in the Federal Reserve Bank of Boston's work with MIT, the other of which is to identify, scope out, deal with, analyze the various public policy issues. As you mentioned, we do intend to publish a discussion paper soon that will be the basis for a period of public engagement with many different groups, including elected officials around these issues. We think it's our obligation to do the work both on technology and public policy to form a basis for making an informed decision. The ultimate test will apply when assessing a central bank digital currency and other digital innovations is, are there clear and tangible benefits that outweigh any costs and risks? We're also, as you know, investing heavily right now in building a new settlement system for instant payments in the U.S. It'll be the first such major expansion of our core payment system since the 1970s.
Which charge? I usually do the 10-year.
Quite compelling. for consumers, businesses, and just ensuring that all financial institutions have access to the payment system. So bottom line, we haven't made a decision about the CBDC, but we will be issuing a discussion paper soon in order to form the basis of this public interaction that we'll have. Thank you very much.
If I can have a quick, can I get a quick follow on that? Thank you. I'm just wondering if you're okay. Are you concerned at all with kind of falling behind in the global race for digital currencies?
I think it's important that we
That was a no.
get to a place where we can make an informed decision about this and do so expeditiously. I don't think we're behind. I think it's more important to do this right than to do it fast. We are the world's reserve currency. And I think we're in a good place to make that analysis and make that decision. By the way, which will be a government-wide decision. We would do this. We would have to have a meeting of the minds with the administration, and also probably with Congress. We would really like to have broad support for this. It's a very important innovation, and I think we would need that to go ahead, and that's the process we're engaged in. Thanks very much.
Yeah, he's done.
Thank you.
He's done. They are gonna leave now. There we go. And I got it. I closed it before the music. Good deal. Okay. Oh, so I wasn't even paying attention. What happened at 1 o'clock? Okay, they balanced, I guess. So we'll see if they make another move going into the S&P 500 close. Kind of an interesting set of turns, don't you think? I think I was kind of vindicated there when it came back that, hey, you know, the price might not mean anything. So thank you, Dave, for another donation. We appreciate it. The 30-year is ZB. 5-year is 5. F for 5. N for 10. And B for bond. And that's how they get the letters. I don't know. God, they look pretty happy at 03.5 there, but isn't that like, yeah, the 03 is basically where we started the day at today, so I don't know. You are worth it. Thanks. Well, I appreciate the donations, but you know what helps the channel out the most is you watch the videos all the way through and leave comments on them. And not just I mean like the one-off videos. That's what really helps the channel out. So, I mean, it kind of looks like it maybe wants to move back up. I don't know. I wanted to take it off up in here. I didn't quite get to where I wanted to. And smashing that like, there you go, slashing that like button helps a lot. You can also follow me on TikTok if you watch TikTok. That helps too. Man, I don't know. They gonna try and smash me again? They gonna try and go back up into the 08 halves areas? You're on crude now. Okay. Hey, oh yeah, this is going well. It's going well. Now gold did come back. I don't know. Everything that I'm seeing right now, this still kind of looks like a well, actually I take that back. Like we had the liquidity pocket and everything. It kind of looks like it's flattening out. Like it looks like maybe they, you know, I wasn't paying attention at the top of the hour. Probably when we wanted to take stuff off. Although there is a little bit of a, oh, I don't know, they are fairly in line. Looks like all three of them moved up equally on that. Because everyone trying to short it plus retail indicators screaming short equals fueling the rally in crude like oil always. I like these moves in oil are a little bit cleaner than they normally are, when you say. Okay, so we're going to start the last 30 minutes here. I'm liking Vlad's new name, Captain Price. Just seeing the earlier comments there, I was like, oh, that's good stuff. And he's got a cool image. I don't know what it's an image of, but it kind of looks cool. It's a nice blue color. Okay, so a little bit of flattening here again, the 5-year pushing. Look at that. Not too much though. That 102 isn't doing anything here. The 6J kind of suggests maybe we're going to turn back down. Isn't my blue color nice? Yes, Sticks, blue color is nice too. Mundo's a little green. That one, like, cool little green energy ball. See, mine is just a picture. Mine, I think, looks weird. See? It's kind of, I mean, you can see my face and everything, but, you know, it's not the best. I don't know. I could maybe use a better picture. All right, back to the L3 half, I should change it. I need a blue one. I can clip your face in stream. Oh, you know what? We should see me. I have the camera on. There we go. You have the camera on. How you doing? So, you know, when it was down here like 02, we were still at one spot, 320. But now when we go above it, they drop 4 points. So they're not in sync completely. Blue is trustworthy in marketing site. Oh, really? Okay, I need to use more blue. Is that what we're saying? I don't know. So, like, they're still kind of trying to push it. But look, it's doing it on very little volume, so. Very little volume, and then it's not really, like, reacting as it does it. Even you get it turned back down? And where the ES ends today, that's going to be interesting too. As soon as I say that, my monitor turns off and turns blue. Wait, what? You got a blue screen there? No, I didn't see that. Tapering conclusion around mid-2022 may be appropriate. Hey, did Zero Hedge change all of their stories when everything flipped? Goldman warns of oil spike to $90 if winter is colder than usual. I saw that earlier today. Fed Chair Powell reiterates that tapering is not tightening. It is. It will increase rates. The net effect on the market will be that rates will increase. Because right now, the Treasury is buying up all of the supply. People will actually be able to buy treasuries again. Yeah, is that going to affect the interest rate? It will. During his prepared remarks, Fed Chair noted tapering ending around mid-2022 may be appropriate. That fixed the expectations of a taper start in December with a $15 billion taper per month. Yeah, I didn't really add anything. Ugh. Hello from Europe. Hey, I think you like the screen setup. I often think, my it's probably not the most. That's probably a little overwhelming for people when they first come in, but. The E-mini a little bit more directionless than I anticipated here going into the last 30 minutes. $43.92 doesn't look like a bad spot. You know what? I've already managing this over here, so I'm not gonna bet. It seems like you should buy that. And okay. Perhaps some inverse correlation with the E-mini there. That 03 half kind of looked like it was firming up, but then only one order even hit it, and they all pulled. Do you know Bloomberg Terminal? Sorry if my English isn't perfect. Yeah. I wish I could afford a Bloomberg Terminal, but it's like $20,000 a year or something. I forget the exact number. I'm not that great of a trader. Nope, quite. We're just risking $3 here, right? But, you know, if you guys make sure to comment on the videos and, you know, subscribe to the monthly subscription here on the channel by clicking the join button down below, which gives you access to our Ninja Trader indicators and a members only section of the Discord. And then maybe in the future, we'll make enough that we can get a Bloomberg terminal. And that would be awesome, wouldn't it? I don't know if that one's ever going to happen. Going to hire an employee before we get a Bloomberg terminal, I'll tell you that much. What are they talking about here in the interest rate channel now? I think the statement proves that there will be no taper this year, no matter what random street analysts think. How do you get... Wait, what? With dollar, the union will endure. Dollar Chad, you there on Discord, still talking about that. Come on, guys. When is it better to use a market order versus a limit order? Well, it depends on what the bid ask is, right? Like, and how desperate you are to get in. Like, let's say right now that I really, really wanted to be long the 10-year treasury, right? Would it be better to try and get the fill? Well, okay, they just changed, but so we'll do it there. Is it better to wait for the fill at 03 or to market buy into 03 half? Well, what are the chances that you're going to get filled at 03? It's quite a bit less, right? That's been pretty solid there for a while now. They've been trading back and forth at 03 half a lot. So you know that you can probably get in at 03 half real easily. In fact, even if it ticked up, you could probably put a limit order at 03 half and still get filled, most likely, right? So, you know, it kind of depends. If I'm doing like an against the grain kind of trade, then I almost always want to be using a limit order. Whereas if it's like I think I know something, I almost always want to be aggressive because I'm more worried about it running away from me. Larger term though, if you're doing market making kind of trades, then probably you want limit orders, right? If you are detecting an iceberg, you would be better off with a market order to trigger the market maker to F over the meta order. I don't know about that one. I don't think that what you do on there is going to change anything. I think it entirely has to do with the trade-off between getting a better price and not missing the trade. Right? Could you still bid at 03 half? Maybe. But it might. What if it trends and it comes away from me now? I don't know. Probably better to move your bid up to 04 Or if you really, really think it's going to move here, I'd just be hitting into 04 half right away, right? If I was scared. Early market on close and balance 469 to the sell side. Interesting. By the way, while I'm thinking about it, why is a Chinese company named Evergrande? That doesn't sound right to me. That doesn't sound like a Chinese name. Explain that to me. Does anybody sat down and thought about that one for a second? You see, you guys, you totally get what I'm saying, right? So they can get foreign investors. Is that really what it is? Is they were always intended on getting foreign money? That all three have their pulled, but they didn't clear it. Sounds American. Yeah. Seems a little sus to me. Just saying. But apparently the amount of foreign investment is not that big. Well, apparently they owe a lot more to foreign bondholders than to domestic ones. It was like 30 billion versus 80 billion or something like that for Thursday, just for Thursday's payment. Red is sus. Do you know that like red is considered a lucky color in China, and that they have you can't have a red team and a blue team because all of the Chinese will always pick red? It's true. LDS church to mandate masks inside of temples. So they weren't already? They're going to be... Okay. That doesn't seem like news that the Hill would normally cover, but okay. Okay. I'm really surprised at how much they bounced after that push down, and then they came all the way back up to 03 half. Like, there was definitely like a stop run there, but we have been drifting down a little bit, at least in the 5-year we have. Not so much in the 30, it's flattening. I think what we might see as it flattens. Initially it flattens, and then maybe later will steepen, because that 30-year is going to have to come down a lot. Like, think about it. You're getting one spot, 319 for 10 years. And then you triple that, and you're only getting one spot, 842. That's all the risk premium you get is half of a percentage point. 500 basis points. Don't know. What's the normal risk premium? Seems like it should be more than that. What's a marketable limited order? I don't know what that means, to be honest. You can always convert your limit order into a market order, I suppose. This research paper says that it's the best kind of order for I've never heard that term before. That's weird. They want to hold bid at 04.5, apparently. Ugh. So after Powell speaking, everything seems hunky-dory. Well, I think that the stock market actually cares more about the Evergrande risk being off the table now. Yeah. I don't know. The interest rates seem to be determined to give me a loser here on the micros. They just made the coupon payments. Well, I think they make it tomorrow, right? Or tonight. I don't know. I don't know when it is. I don't know when it is. But there was that bigger news story much earlier today around, let's say 11, let's say around noon Eastern time, that China was basically already close to a deal that would restructure the company. ZNZB is a good trade. They move like my grandma. They moved a little bit too fast for me today, apparently. So I had a good winner there, and then it came back on me, basically back to break even, and it's being really finicky here, and I'm a little frustrated. See, like I gave up 250 over here on this. I wanted it down there. Why is it not falling back? Why are you not falling back? Maybe it will do it. I bet you one of the things that it does is like falls during the break. That's done that a few times. I don't know. Maybe I'm wrong, but the L5 half that we were at earlier today is just too high. They were high today anyways. Wow, market on close imbalance is now 2.2 billion. Or was 2.2 billion when the final number came out. Really? Do you think the market will just correct the rest of the week? No, I think we'll probably continue to get some good moves tomorrow. As they really sort things out. I think that that's going to mean higher rates, but it doesn't look so good at the moment, does it? Like, how does that happen? It just went from break even to down $30, just like that. Well, $15 on per contract. That's like a big move. How is that happening? Someone must still believe that they want the rates. Slippage. I should do this right here. Should get at least the 125. And even this move up in the treasuries could be the Evergrande thing too, to be honest. You can see we were all the way up here at one point, right? And the rates are not matching them. Isn't that ever so grand, Seth? And there's still some market orders out here too, huh? See y'all tomorrow. Yeah, well, we're ending here in a minute or so. Gotta get back to work. My stick is like, oh. I don't want to hold this in the close, so I don't know what I'm going to do over here. I'm going to have to manage it somehow. The end of the rally. Well, they got it. I had like a really odd double hump there, huh? Looks like some shorts taking profits here. Like a bunch of people went short to be able to feed the market on close imbalance. Yeah, lots of volume there for the close. Lots of volume there for the close in ES. Really, that didn't fill. My 10-year one didn't fill yet. The ZN didn't fill. What if you looked at Kelly in the markets as a continuous based on your position instead of just your entry price, stop loss, and take profit? Instead, what if you looked at the current market price as your entry price? I'm not sure I follow. So like because as price goes up, your stop loss goes further away and your take profit comes closer. So your max loss is higher and your max gain is smaller. Well, that's not what you would want, right? Learn umbrella high said, what do you mean by market imbalance? Are you talking about when I said the market on close balance? So there is a closing auction that they have in the S&P 500 where large institutions can just choose to buy at the whatever price it is at the close. And there's reports, you can sequentially see how much it is. And then 10 minutes before the close, it gets cut off. No more market on close orders. And you can see what it was. So the imbalance today was like 2 billion. So in the last 5 minutes there, somebody added on like a big sell for some reason. So some of the market makers were kind of taking positions so that they could fill that demand for the market on close. Okay, well, the treasury is coming back down a little bit. Back down to the other side of this, though, 404.5. So your entry price isn't irrelevant? Well, I mean, I don't think that your entry price or the current market price really tell you a whole lot about what your future returns are going to be. So I don't know if it would really help you all that much. All it would do is it would be like, you know, what if you just brought your target in general, right? Anyways, you know, we have to cover it tomorrow because I got to get going. All right. Stay profitable, friends.